Hello and welcome to the weekly commodity market update. I'm Brownfield's Will Robinson, joined as always by the University of Missouri's Ben Brown. Ben, how are you?
I'm doing well. How are you, Will?
I'm doing all right. We seem to always be on the road one way or the other. You're finally back in your office, and now I'm at McDonald's. So
We're just busy people. We got
exactly,
places to go and people to see. Speaking of which, did you have a good Thanksgiving?
I did. Went back home. Went to Missouri. Had a good time seeing both sides of my family, and really thankful for the holiday season and getting that chance to go home and see my family. So
Good.
that's
Yeah,
tough when you're out of state. So, Ben, hopefully you had a good Thanksgiving experience.
I did as well. I got to go home and see my folks and family, and we had a really nice Thanksgiving. So,
Oh, good deal. All right. Well, I'm going to give some price recaps on the shortened trading week that we saw last week. Really light losses across most of the board here on the week. December 23 corn was down 12 cents at 4.55. December 24 corn down 6 cents at 5.04. January 24 soybeans down 33 cents at 13.30. November 24 soybeans down 21 cents at 12.80. Then soybean oil on a cents by pound basis in December down 1.63 cents, not a dollar. Soybean meal by the short ton for December down $22.10 at 436.60. Wheat for December 23 down 9 cents at 534. July wheat for 24 down 10 cents at 589. And then that crude oil contract for January down $3.36 per barrel at $75 on the dot. So, Ben, as we see these losses across the board, what kind of enters your mind on what really stood out to you on the shortened week?
well, first thing, of all the weeks that we've been doing this, Will, how many weeks have we had it to where everything was down?
This is one of very few.
Yeah, I don't remember many. I'm sure I could go back and look at all of our files, but that's just something I don't think I'm going to spend the time to do. But down across the board on a shortened trading week, I think there's different factors impacting different commodities. So I don't think it's one thing in particular that's dragging the whole complex down. But in general, this reset of commodity prices is happening. We're certainly coming down from very high prices. And I think that's going to kind of continue. We're going to see these little rallies from time to time. So for producers that don't have grain sold, or maybe have grain that they've put in the bin and waiting for higher prices to return, I think those rallies are going to be few and short between, because I think we are resetting to more normal price levels from record highs the last 18 months.
Well, and Ben, I know we've talked about this in the past, looking at things like that nearby corn contract, having that hard cap at $5, and it keeps tracking downward from there. And, like you say, it seems like the market continues to just level out.
Yeah, I think we are finding, a return to normal. I don't say this with joy in my heart because I'm a crop producer's son, right? I really like crops. I like cows too, but I like crops. But when I put my enterprise budgets together for the University of Missouri, when I was budgeting our prices, my price for corn was almost $1 lower than what the futures market was trading at the time. And we've constantly been watching that come down closer and closer to where I'm at. So I don't say that to brag or anything. It just, it makes me feel a little bit better about my estimate, that the prices are kind of coalescing around where I thought they would be.
Well, and as you kind of tease there, maybe not so great for crop producers, but maybe better for beef and pork and anything else that takes any kind of feed input. But Ben, we saw some interesting news on the week. So we saw an EPA reversal of a decision on small refinery exemption coming out of the Fifth Circuit Court. Can you go into what this means for renewable volume obligations and basically looking at what this just might mean across the board for renewable fuels and agriculture?
Yeah, so a little bit of background here for some of maybe our new listeners or people that aren't familiar with the U.S. renewable fuel system, to be truthful. We have this federal policy in the United States. It's called the Renewable Fuel Standard, or the RFS is what many people will call it. That has been our guiding policy for renewable fuel use in this country since 2007. And the policy has largely operated under that rule. There's been some minor, just kind of tweaks here and there and interpretations and different things, but that has been kind of the policy. Certainly, we've seen state level initiatives to kind of create state level RFSs, but the big one is the national RFS. It's the one that provides levels of biofuel use in our fuel system, and it really kind of drives. Um, it's the policy that people look at when we talk about biofuel use, right? And I won't go into the complexities here because it's for some fuels like ethanol, it's not really the driving factor anymore in terms of how much we totally use, but it is important. And so I say that just as kind of that's the baseline. But the program is very eloquent in nature because it was designed with this idea of compliance, and people aren't going to go out to a gas station or a petroleum supplier and say, "Did show us every gallon of biofuels that you blended?" Instead, what they did is they came up with this system called RINs, or renewable identification numbers. And so for every gallon of renewable fuel or a renewable product, whether that's ethanol, biodiesel, renewable diesel, cellulosic fuel, they all come with a RIN. And when that gallon gets blended with petroleum products, that RIN is then removed. And at the end of the year, to uh, meet compliance measures, those RINs are then provided to the US EPA, or the Environmental Protection Agency. And those RINs have a price. So if you don't blend ethanol or biodiesel or use renewable diesel, you can actually go into the market and buy these RINs. And the RINs are a measure, or I shouldn't even say measure, but the RINs themselves, the prices, if it's going up, that signals that the demand for those RINs is high, and if it's going down, there's more supply than there is demand. Companies can then use the money generated from those RINs to invest in additional infrastructure. So it's really kind of a forward-looking policy, and that's why I say it's very eloquent. A lot of people don't understand the system, but that's what it is. And so this ruling,
Ben, just to cut you off real quick, it sounds almost like the early construction or ideas of what a carbon market program might look like. So just based
there
on
are similarities. There are similarities. The biggest difference, I think, between the RIN market and the carbon market is you have verification that it got blended and it exists, right? With carbon markets, there's still this
a little
verification.
loose, yeah.
And there's still this verification and permanence issue, right? That we have to deal with. That's a whole different topic. We could talk about carbon, but there are similarities. There are similarities. And so that is the basis of RINs, and that is the basis of the RFS. To the specific court case you're mentioning here, in the previous administration, so during the Trump administration, there was a multi-year battle between oil refineries and renewable fuel advocates about small refinery exemptions. Basically, this was this was a section put into the RFS that basically said that if small refineries were facing hardship, that they could file for exemptions from the RFS and did not have to meet compliance standards. And the Trump administration and the EPA really battled this. They were trying to make both sides happy, and it's an issue that neither side is going to agree on. And so it's a zero-sum game. Somebody's going to win and somebody's going to lose. And the Trump administration really tried to play that. The current administration, when President Biden appointed Michael Reagan, who comes from an ag background in North Carolina, they took a very definitive stand on behalf of the Renewable Fuels Association that no, we are not going to approve these hardship waivers. And so in April of 2022, these hardship waivers were denied. There was another batch in June of that same year and denied again. And so that is what this court case is about. And basically what the EPA did is not the EPA, the court system did is it came through and it said that the EPA had overstepped and did not have the justification to deny these hardship waivers. And it was a big setback for the renewable fuels industry and really, the ethanol industry, because it sent, well, I shouldn't even say the ethanol. It was a setback for the renewable fuels industry and especially biodiesel. And we saw soybean oil plummet on this news, and that kind of pulled the rest of the complex down.
And just looking at what that directly means for agriculture within the fuel space, you're signaling to all these refiners that maybe they're more likely to get these waivers, or if they get denied by the EPA, then they can still have due process and get that overturned. So then again, there's going to be less, I guess, implicit demand within the market for some of these agricultural focused fuels. So moving forward, Ben, what do you think is the implication of this?
Yeah, so I think there's two, both a short-term and a long-term implication of this. The first is it sent RIN prices, or those compliance measures, plummeting. That makes it extremely cheap and that to buy RINs to meet the compliance of the RFS. And so if let's just say you're a petroleum producer and you are mandated to turn in a certain amount of RINs to the EPA at the end of the compliance year, well, if now it's cheaper to go out and buy these pieces of paper rather than actually blend the fuel, you're going to buy the pieces of paper. And that's why soybean oil prices plummeted, pulling the rest of the ag market with it, is because the theory is that there'll be less gallons of renewable fuel used because they're buying the paper to meet compliance. So that's the short-term impact. The long-term impact is lower RIN prices also discourage investment in future biofuel investment, in
And research and development. Yeah.
Yeah. And so, I do believe that this investment that we've seen in renewable fuel facilities will continue. I think we'll continue to see that. I think we will continue to see investment in private companies investing in renewable fuels, and corn growers and soybean growers. I think we'll continue to see them invest in advancing higher blends of fuels and stuff like that, because that's all money that's coming from the sector to help support that industry. Where I think we'll see less, of an investment is from, organic fuel companies or gas stations, because they're not generating as much money from these RINs to then reinvest in more renewable fuel capacity. So I think we potentially could see a longer term, kind of dampening, I think, on the outlook. Now, we're still a long ways from this all being settled, but that's simplistically what it means, both in the and the short term.
Yeah. So Ben, I don't want to take up too much more time here, but just looking at how this might impact the EPA and how they move forward, and looking at assessing these waivers, do you think this action is going to adjust maybe how the EPA operates with small refinery exemptions?
So it's hard to say. So the court ruling sent the waivers back to EPA and basically said the way you determined that these were going to be denied is not correct. It did not say the EPA could not eventually deny them. It just simply said that the way you did it this time is not within the law, and therefore we're sending it back to you. So I do think the ball's back in EPA's court. It's back at the administration level, trying to figure out how to, basically come up with a system that works. And to date, the Trump administration really struggled with this, and now I think the Biden administration is struggling with this, is neither side is happy. Both sides have an argument to play, and as a result, we end up with this pinball back and forth. And RIN prices are certainly caught in the middle in terms of, what ultimately ends up happening.
Yeah. Well, Ben, as we look forward to this week, we're getting back on track with some of our normal reports. So what should farmers and ranchers really be paying attention to?
Yeah, so it's the end of the month. This is also the end of the December trading window for December corn. So we'll move to a new nearby contract here pretty quickly. Volumes are still very high for December held contracts. Those will get rolled to March and canceled out and different things like that. So, kind of maybe a little bit of volatile price action here as we round out November and turn the calendar to December. Also, December is a prime month for growing conditions in South America, and I think we're going to see some market volatility given rain showers and things like that here as we turn the calendar to December.
All right, Ben, it's always a pleasure to have you and your knowledge on the program here. Viewers, listeners, if you'd like to learn more about us, what we do, you can check us out at brownfieldagnews.com. You can also find our sister program, the weekly livestock market update, at the same place. Ben, thanks again. I'm Will Robinson on Brownfield.